This is Alan Bush with the Daily Financial Forecast for Tuesday, August 21st. Tomorrow is likely to be a red letter day, or maybe we should call it a green letter day, because that will mark the longest bull market in history by most measures. Don't forget, we had the stock index futures making a low in March of 2009. So with Wednesday, of course tomorrow, that would mark the longest bull market in history. Let's call that a green letter day. Nothing has changed in the long-term outlook. There have been plenty of geopolitical problems, some more severe than others, including the more critical and the timely U.S.-China trade situation, which has caused some pressure from time to time. But each and every time we've had these geopolitical problems, and there have been quite a few, stock index futures have been able to recover. The main reason still is that we have the relatively low U.S. and global interest rate environment that always comes to the rescue. So I think that is probably the main reason why we have sustained this bull market for so long in stock index futures. Moving over to the currencies, the dollar index coming under some pressure. This after yesterday in an interview, President Trump indicated some criticism of the Fed raising interest rates. So that tended to undermine the dollar and to support most currencies, with the exception of the yen, with flight to quality longs being liquidated in the Japanese yen today. Moving over to the interest rate futures markets, normally you would think that futures would trade higher if there is pressure on the Fed not to raise rates. Of course, I don't think that the president will have any impact whatsoever on Fed policy. But in any event, interest rate markets lower, especially at the long end of the curve, lower in spite of what I would consider to be bullish news. So that may be a sign of weakness when any market does not respond to news, at least bullish news, as the interest rate markets are today. The Fed, of course, has raised rates twice this year, and there appears to be 2 more rate increases coming from the Fed, one in September, probably another one in December. So from here, I would expect some lower prices in the credit markets. The long term seems to be most vulnerable, and that would be the 30-year Treasury bonds. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.